On to our last speaker for this afternoon from Regis Resources, Jim Beyer. Jim has been the MD and Chief Executive Officer of Regis Resources since late 2018. Jim is a mining engineer with a broad range of strategic, operating and startup experience encompassing 30 years across a number of commodities, including gold, base metals and iron ore. Prior to joining Regis, Jim was the CEO of Mount Gibson Iron for 6 years. He holds a Bachelor of Engineering degree. Now, he assures me that it's from the undisputed best mining uni in Australia, which is Queensland Uni, so I have a feeling that's a bit contentious there. Is a Master of Geoscience and is Vice President of the Association of Mining and Exploration Companies Executive Council. Over to you, Jim. Thank you.
Right, thanks, Jane. And I appreciate the opportunity to present the Regis Resources story again this year, particularly to this esteemed audience, both local and online. There is a fair bit of pressure. People are hanging off every word, I'm sure, not because they're particularly interested in me, but because they know that the next thing after this is free beer. So I will do my best. Regis, a company known for its consistency. First of all, I do draw your attention to the cautionary statement. But a company known for its consistency, but now it will also be known for its growth. And today I'm going to outline our business, both in terms of where the consistency stems and also the areas that are and have been and will be delivering the growth in future. So, first off, let me just talk about the three key areas of our business, the three key value sites. There's Duketon, there's Tropicana, as Mike was talking through before. We recently acquired 30%, and we have our large 2 million ounce deposit project over in New South Wales called McPhillamy's. As a business, we have a strong cash generating capability, and at the end of the June quarter, we're sitting on $269 million worth of cash. In addition to that, we also, while we understand that consistency and growth is important, we also understand that return is also important, and point out that since 2013, the company has paid over $500 million in fully franked dividends. So we see growth and returns as an important part of the reason to be. Now, first of all, I'd touch on our ESG reporting and the transparency there. And what we've found certainly as the company has grown and we've been exposed to other parts of the world and new sectors of investment, in particular in the generalist space, we've seen a heightened interest in what we do and how we behave and what the outcomes are from our business besides just cash and bullion. And so while we know that we've been doing a lot of good, as has pretty broadly saying the mining industry does and has done for a number of decades, we do need to show where that is and what we've been doing. And hence, we have been increasing the degree in our reporting and our transparency in the ESG space. Now, I'm pleased to say, just on a couple of fronts, we've had some exceptional performances over the last couple of years. In the safety area, over the last 2 years, we've dropped our lost time injury frequency rate to around 5 lost time injuries per million man hours to 1.3 at the end of June. And so we went from being well above the gold industry average to now being well below it. And that's an outcome that has been hard work, but well done by our operation leadership group. I also point out that our gender diversity in this particular, at the moment, is sitting at around about 22%, which also sits above the industry average of around 18% for the resources industry in WA. So we have been delivering improved outcomes, and we've also been increasing the degree of external reporting and transparency as part of our, what we see as the obligation of becoming a more broadly appealing company and investment opportunity, in particular to the generalists, to be able to explain to them what we do in the background of just producing gold. Looking at the company, as I said, we've been consistent, and you can see from the production graph, certainly for the last 4 years, we've been consistent producers. And now we've got growth. So our production, or our guidance for this year, sees our production lift of a guidance range of between 460 and 515,000 ounces of gold. Our all-in sustaining costs will be in the range of $1,290 to $1,365, and our growth capital spend will be between 155 and 165 million. So you can see where our growth is coming from. And certainly this coming year will be a substantial change from the consistency over the last 4 years. Now, looking at where the growth comes from and how we look at growth internally within the company, we use this slide to illustrate the story. The first element of our growth sits around the existing assets at Moolart Well, Garden Well and Rosemont. And then we've got a step change of performance that's come from Tropicana. We look at our underground operations at Duketon, which we see as being incremental, but a very important part of giving us incremental improvements from Duketon. We've got another step change project sitting in McPhillamys. And finally, we've been really increasing the amount of focus, and by focus I mean expenditure, on our exploration around the Duketon belt. So I just want to step through each one of those areas and give a little bit of background as to what's going on. Firstly, looking at our Duketon operations. Just to describe in basic terms, we have 3 mills. We have the Moolart Mill sitting in the north, about 2.5 million tonne per annum. We have Garden Well Mill of about 5 million tonne per annum, and we have Rosemont sitting about 15 kilometres to the northwest of Garden Well, which is about 2.5 million. Now, Rosemont's actually connected to Garden Well through an umbilical cord. At Rosemont we have crushing and milling, but we pipe the slurry down to Garden Well for extraction and pouring at the tanks there. Now, Duketon, the guidance this year is to produce between 340 and 380,000 ounces of gold. We'll sit at around 1340 to 1410, $1,410 an ounce on our all-in sustaining costs. And our growth capital at Duketon this year will be between 85 and 90 million. Now, most of that is going to be involved, about 75% of that is in the growth capital phase of our new underground mine called Garden Well, the Garden Well Underground, which is continuing on the Garden Well open pit. Our reserves at Duketon are now sitting on 2 million ounces. And after some optimisation work and some excellent more exploration work, we've now pushed the mine life out from 5 to 7 years at Duketon. So we've seen a real optimisation that's delivering both an improved production, stabilised our costs, and also significantly increased our mine life. Looking at the underground, which is really where we've produced or been able to deliver on incremental growth, or more the point, I think what the undergrounds have been able to do at the least is to prevent a slide in production, which is what we were seeing. Without the underground, arguably the best years of Duketon's production-wise might have been behind it, but with the high grade that we get from the underground, we're able to reel that back and get our production back consistent, and in fact look for a little bit of growth over the next year or two. So Rosemont was the first cab off the rank. That's sitting in the, you can see in this slide, there's a Rosemont where the development work has been undertaken. We hit consistent production during the June quarter. In fact, we were able to catch up a little bit of what we was a little bit behind the 8 ball in the March quarter, but we stabilised that. There's quite a bit of learning that went on during the second half of the financial year last year, while we got to understand the Rosemont ore body a little bit better. And I'm very pleased to say that that's back on an even keel and is now producing quite consistently. In fact, at Rosemont, we see growth opportunity, as we were hoping we would, both down plunge, which is where we were expecting to see more intercepts, and we are seeing that. We've seen some exceptional grades in the main zone, which is very pleasing to see. Interestingly enough, we're also seeing some colour sitting between the main and the central zone, which we weren't expecting. And we were getting ready to do some drilling in an area which, but quite frankly, previously we thought was barren, but now it looks like hopefully that's going to present itself with some more colour for us. And we've also identified an area in the deep south, which you can see over on this slide over here, which was an area that was historically we gave it no recognition of being an opportunity, but in fact is shaping up to have great potential to give us another production zone at Rosemont. So Rosemont itself, we've got it running where we want it to be, and what we're starting to see is what we were hoping or expecting to see, which is extended life and in fact maybe a little bit more production and better grades from the south as well. Just recently we started the Garden Well underground, which is sitting, the first phase of that is sitting to the south end of our Garden Well pit. Development started a few months ago. We were about 450 metres in. We're not expecting to hit first ore until late in the December quarter, and it really won't make too much of a contribution to this year's production. We were expecting we might get some ounces or planning to get some ounces out of it in June, but it won't be a substantial contributor until next year. Again, that's a new zone. It's open down plunge, as you can see on the diagram that we've got. The exciting element for Garden Well as well is that to the north and sitting underneath the Garden Well main pit, we've been doing some drilling there, and that's really starting to shape up as another potential underground production zone as well. It sits, I think, probably about 700 or so metres away to the north. We're very excited about that, and the drilling that we're getting there continues to deliver some very encouraging results. So all in all, the underground, and in addition we've got sitting underneath a number of our pits, we have underground potential. So we're very pleased the way that Rosemont has finally started to deliver. We have learnt from our first underground mine. We're applying the learnings from that to Garden Well, and we're very excited about starting to open up Garden Well as well, and also with the potential that's sitting underneath the main pit. And we have Gloucester, and we have a number of other underground potentials as well. So this whole incremental growth from the underground certainly continues to shape up as more value potential. Moving on to our recent acquisition, 30% in Tropicana. Mike did a great job, I think, of talking through the potential there. And I'm going to be a bit like a broken record, I think, just repeating it, because it is for us, for both of us, I think, it's very exciting and it's got great potential beyond what it's currently seen as having. For us, it gave us a step change. It's still in its investment phase while the Havana cutback is undertaken, and we continue to run up the Boston Shaker. But the guidance for us for this financial year, 120 to 135,000 ounces, 1,045 to 1,125 all-in sustaining costs, dollars per ounce, and $70 to $75 million in growth capital. We like it. We think it's got great potential. It will grow. We see that as we move out of this investment phase, we see production lifting back to the 450 to 500,000 ounce capacity. And I think, as Mike was talking about, that'll be towards the back end of calendar 22 when we can start to see that. So while we won't see that benefit coming in this financial year, it's certainly something that we're looking forward to in next financial year. It's got 10 years plus, no doubt about it, potential. It's got a strong history of reserve replacement, and we're very pleased to be there and very excited for where that's going to go and how that's going to sit in our portfolio. So a little bit more, where does that growth come from? Well, from the immediate, we see the Boston Shaker is certainly starting to kick in the underground. And also, as I mentioned before, the Havana pit will certainly make a huge difference as we're able to transition back from dealing with or processing the stockpiles that we've got and back into the high grade that will come out of that 1.5 million ounces of material, of reserves that are sitting underneath the cutback at Havana. Where next? Well, I'll repeat again what Mike was saying. There's plenty of opportunities sitting underneath Havana, and that'll be some interesting work that we come in with the underground. Clearly, there's opportunity down plunge of Boston, and there's certainly, I think, as the development that's pushed out towards Tropicana and underneath the old pit there, I think we're all waiting to see how that's going to play out, but all the indicators are there's some pretty interesting information coming out of that, and we're looking forward to the good news that we hope will come from that. But it's certainly an untested area and very exciting opportunity as well. And so when you look at the extension of Boston Shaker, you look at the opportunities that sit underneath the Havana pit, and you look at the untested area and this potential proving up that's sitting up Tropicana, there's plenty of opportunity sitting at the Tropicana operation, and that's just looking at the underground. That's not talking about the other potential that sits at surface and satellites. So we are very excited and very pleased to be there working with Anglo Gold Ashanti on that. The next opportunity that we see organically is McPhillamy's, a 2 million ounce deposit sitting in New South Wales, grades around 1 gram a tonne. Production rates, the mill there that we're proposing, about 7 million tonnes per annum. So we're looking at somewhere between 170 to 200,000 ounces of gold per annum. We haven't updated our capital since a few years ago, but we've been certainly guiding up until recently that we anticipate the infrastructure and the process plant itself will be somewhere in the vicinity of $350 to $400 million, and the costs currently looking at like somewhere between $1,100 to $1,200 an ounce all in sustaining average over the life. It's in its permitting phase, which is certainly a process that you have to go through, frustratingly, but it is making progress in New South Wales. DPI Planning, the Department of Planning, Infrastructure and Environment, have been very supportive working through. We've got a number of administrative items that we're closing out with them, and we also have the key area of permitting with the surface water licences. There are 3 types of water licences that we have to have. One of the water that we use, one for the water which is sourced from a coal mine about 80 kilometres away, that's fine. One is the groundwater that we take out, and we've got those. This is the last element for the water that we actually catch and divert around the mine site or capture on our site, and as simple as it sounds, it appears that it's extremely complex. We just have to work our way through it. We certainly, while we can never dictate to the government what we can ask them what we like, but we see the potential now for the approvals to come through during calendar 21. Although, as I said, that's not guaranteed. But we have a very supportive ministers, and we have a good supportive DPI planning that are helping to push that along. Finally, on the DFS front, the definitive feasibility study, which we have been working on, we continue to bring that to closure. We are planning to finish that during August this month. Hard to believe it's August already. COVID is having some impact on that. It's causing frustratingly difficult access to site for our bidders and for ourselves as well, our engineering team. But it's also interesting, we're seeing COVID and there's certainly some buoyancy in the market. And we're talking about the iron ore price with Peter, and it's been up over $200 a tonne, which is great, unless you're wanting to use steel, because that does happen to flow through into the cost of iron ore. High copper, high labour, we're seeing that come through. What we're also seeing is an element of, certainly in the EPC part, some elements of the pricing that we're getting in, and we've only just been receiving them, but we're certainly getting some what appear to be provisions for COVID-related risks and potential COVID-related delays, which we hadn't. That's what we're interpreting at the moment. We're working through with a number of the bidders there to make sure we understand what that is. But in some of the packages of that project, that appears to be putting a bit of pressure on the pricing. So we are working to make sure that we understand how we can de-risk that. But we're still very excited about this project. A 2 million ounce deposit. It's at I said, $1,100 to $1,200 an ounce, all in sustaining. It's a great project. It's just something that takes time, and we're working on it. and we will continue to push that project along. Finally, I just wanted to talk about the last element of our growth and the internal growth elements that we're looking at, and that's around the find it bit. You can develop it, you can build a project on it, you can optimise it, but ultimately you also need to find it to give yourself some extended life. And that's what we've been really ramping up at Duketon. So we now see ourselves with two major areas that we're particularly excited about. The Duketon Greenstone Belt, which probably about 18 months or so ago we increased our holdings threefold there. We have about a bit over 95, around about 95% of the ground there, 3,000 square kilometres. Very exciting. A lot of it has been underexplored, or certainly hasn't been explored with modern knowledge and modern approaches. So it's still very early days for us through that area. And we are finding a number of interesting targets, and as much as I'd like to be able to say that we're going to find a 1 million ounce deposit in the next month, it just takes time. But fortunately, with 7 years of mine life sitting at Duketon, we have a bit of time to do that. So while we're approaching it in a speedy manner, we're not rushing it, and we're managing the risks of exploration around that front. The other area, which is our new baby that we're part of, is sitting around the Albany-Fraser Belt and around Tropicana. Itself as well, to a large degree underexplored, some very exciting targets there, and there's some real parallels between these two areas. Plenty of prospects crying out for a well-structured program, which is now being put in place, and a well-funded program. So we see both of these areas are being particularly exciting, and I don't think either of these exploration programs are going over old ground and looking at tied exploration ground. This is new and exciting territory on both fronts. So, summing up, where does our growth come from and where does our consistency come from? The consistency has been coming from the Moolart, Gardenwell and Rosemont portfolio of operations at Duketon. We've been able to get that to be consistent, and we've also been able to extend the life, which we think has been a great exercise in adding value to our existing business. We've seen a step change in our business. The growth has come from a step change at Tropicana. Pretty exciting for us. We like it, and it's great to be part of that exciting operation. We've seen the additional underground mine, the first one at Rosemont. It's been a bit of a learning curve for us, certainly in the first 6 months, but in the last 6 months this year, we're really starting to hit straps. The team are doing a great job there, and we're looking forward to that continuing on, not just for the next couple of years. It sits within its reserves, but well beyond that, down plunge and strike as well. We see Gardenwell just starting to open up, similar to Rosemont, slightly different. It's not quite, the grades aren't quite as high, but the ore body's much thicker, and that's going to add to our production as well. We see more step change coming in the near future from McPhillamy's. I mean, that's another 170, 200,000 ounces of profile being added to our production, and we see we're setting ourselves up and doing the groundwork that needs to be done for life extensions at Duketon and at Tropicana from our exploration work. So, consistency and growth. And the way we see our business at the moment, we have grown it to a circa 500,000 ounce per annum producer. We've got nearly just under 5 million ounces of reserves. We have over 10 million ounces of resource, and on the costing front, we make our gold for less than $1,000 US an ounce. That's Regis. It's a strong business with many options to keep growing. Thanks.
Thank you so much, Jim. Are there any questions for Jim from the floor? No? such a good presentation, no one has any questions, so you're off the hook. Okay, that wraps up our day one, everyone. For those of you that are on the live stream, it's back on tomorrow at 8:10 a.m. You can crack yourself a beer at home. For those that are in person, there's a cocktail function now at the Clark Energy Cocktail Party in the Marquee. So enjoy, and thank you to all the presenters for a great afternoon.
Thank you. Thank you, Jane. That's wonderful.
Oh.